So hello everybody, my name is Miguel, and today I'm going to be presenting a webinar that is named Macroeconomic Policies in the Eurozone. Here you can see my email, and you can write me any email in case that you have any question regarding this topic, the department, or anything that you consider that is relevant. So a bit about me. Well, as I already said, my name is Miguel Ángel Gavilán, and I'm from Spain. Reason why, since the beginning, I started to learn as much as I could about the European Union and the Euro area. I have taught at the Jesuit University since 2014, where I did also my PhD. And since then, well, since 2 years ago, I'm also part of the lecturer team in the economics department, but also I'm working as a external consultant at the European Central Bank. So let's start with the outline for this presentation. We are going to be covering 4 topics, or 4 points. The first one is going to be about the macroeconomic policies, what they are. The second one, we're going to try to introduce the Eurozone. Then we're going to move to the macroeconomic policies that we can find in the Eurozone. And we will finish with the a very trendy topic right now, which is the COVID-19 European Union, Eurozone responses, which is crucial for understanding the future of the modern economics, at least for the next 3 years. So let's start with the first one. What are the macroeconomic policies? Well, first of all, we have to think in terms of, okay, what is a policy? We can define a macroeconomic policy as a rule or a set of rules which affects the whole economy. As you should already know, or if you don't know, we're going to introduce, economics focuses on economic decisions, in particular, how to allocate, how to assign limited resources. And in the case of macroeconomic policies, we are going to see how these limited resources, or like scarce resources, are affecting the whole economy. We have to be careful here. Why? Because when we talk about an economy, it can be a county, could be a region, like for example, Essex. It could be a country such as the United Kingdom, but also it could be the European Union as a whole, or the Eurozone as a whole. So it's not necessarily focusing, a macroeconomic policy doesn't focus only on individual decisions, it considers aggregate decisions. When we are, we can classify this set of rules in different types of policies. So the 2 big branches in macroeconomic policies are always the demand policies and the supply policies. The demand policies include monetary policy, fiscal policy. You should know that monetary policy is everything related with the central bank, interest rates, and the management of money. While also monetary policy includes financial and macroprudential supervision. And fiscal policies are analyzing what are the how the governments can take decisions, economic decisions, via changing the public expenditure and or taxes. Those policies are going to have effects in the demand side of the economy. So therefore, we classify them as demand policies. The second branch, as we already introduced, is the supply side or supply policies. And these policies include, amongst many other policies, labor market, competition, and innovation. As you can understand, competition can go from a very high aggregate level, so how companies can merge, for example, how you can do an acquisition, how this is going to affect the market, but also you can go at a very micro level where you are analyzing just, for example, the supermarkets market. So does it make sense if Asda and Tesco merge? Are they going to have, are they going to have a strong market power and they might affect prices? This is something that is micro. From our perspective, supply policies in terms of the competition is something much more aggregate. So what are the general rules to allow mergers and acquisitions? And then we have a third branch that is like the black drawer where you can put everything that you want, which are, for example, the trade policies. We have that the trade policies are those that are affecting how a country can trade with a different country. Some of the trade policies can be part of the monetary policy, for example, management of interest of exchange rates, but some others, such as promoting exporting companies and so on, might be, is not a demand policy, and that's why we have to consider as another macroeconomic policy. So now that we understand what is a macroeconomic policy, let's focus on the next, let's go to the next point. What is the Eurozone? Well, we don't have to speak too much about what is the Eurozone, but let's give a brief definition. What is the Eurozone? Well, a pure definition is a currency area. We have that a bunch of countries has decided to join their currency, to merge their currencies in a single currency. In the case of the Euro area, is just the euro. However, we had that a long time ago, there was some efforts trying to achieve a different common currency that was called the ECU. However, it was unsuccessful. We redefined all the regulatory framework for the Eurozone, and we finished with the creation of. Now, you should know that what are the characteristics of this of the Eurozone? Well, it started in 1999. That was the day that the euro was implemented. Today has 19 members. However, those members, we didn't have since the beginning 19 members, we have less, and it represents around 18% of the global GDP in 2019. We have to also know that those countries that are members of the Eurozone also are members of a much bigger union, which is called the European Union. So countries in the Eurozone are part of the European Union, but countries in the European Union, not all the countries in the European Union are part of the Eurozone. We have examples such as Sweden or Denmark, which has decided to keep their own currencies, and in some cases they don't even they are not even member of the famous ERM2. We will go to this point a bit later, but here we can see the map of those countries which are currently in the Eurozone, those which the dark blue, and then we have some others such as United Kingdom, Sweden, Poland, which are non-Euro but EU countries. Special countries are, for example, Denmark. Denmark is a country which has not implemented the euro, but has a very close relationship of their currency with the euro currency. Then we have very interesting cases, such as, for example, Kosovo, which are countries who has accepted or included unilaterally the currency. That means that they are not officially members of the European Union, either the Eurozone. However, they are doing they're using the euro as the currency. This is an advantage and a disadvantage, as we will see. But right now we have some other examples where countries are using the euro as the currency, but they are not proper Eurozone members. So let's go to the next slide, and let's start with the analysis of the different macroeconomic policies in the Eurozone. Well, as we already mentioned, the Eurozone started in 1999 and that's the date of the implementation of the euro. However, the design of the regulatory framework for the Eurozone goes up to 1993, where we have the famous Maastricht Treaty. The Maastricht Treaty was a document that is right now the top regulatory framework in the European Union, which states which were the convergence criteria to be part of the Eurozone and implement the euro as a common currency. We have that there are four main common policies, or if you prefer criteria, we have that those countries must keep an inflation rate below 1.5% plus the average of the 3 lowest inflation member states of the European Union. That means that if you take the 3 countries with the lowest inflation rate in the European Union, for example, let's say Germany, Austria, and Italy, and they have an average of, let's say, 2%. A country could have a 2% plus minus 1.5% in its inflation rate. And if they observe any deviation from this bands, the central bank should intervene to make sure that the inflation aligns with the inflation in the rest of the European members. The second set of rules is what is regarding the government finances, and we have that the European Union, in particular the Maastricht Treaty, set 2 different criteria. First of all, we have the government deficit, which requires that all countries should keep a deficit below 3%. What is the government deficit? Well, as you should know, that the government deficit is the difference between the expenses and the revenues. So if a country is spending 1 million and is getting from the taxes 3 million, it has a surplus or a negative deficit of 2%. So in this case, what we are ensuring is that countries doesn't go further this threshold of the 3% to ensure fiscal stability. Why? Because any fiscal imbalance can have some effects in the currency. The second government finance rule would be the government debt, and it says that a country cannot have more than 60% of public debt, 60% with respect to the GDP. So if a country has a 1 billion GDP, the public sector cannot have, the government cannot have a government debt larger than 60% of this, which is 600 millions. Now, the third rule would be the exchange rates, or regarding the exchange rates, and it says that the members of the European, the countries that want to implement the euro must be part of the ERM2 for at least 2 years, must not have any kind of devaluation, and they should try to fluctuate around exchange rate bands, which in some cases were 2.5% and so on. The last rule was the long-term interest rates, which should be lower than 2%, plus, again, the average of the 3 lowest inflation member states of the European Union. Sorry. This means that some countries, one second, sorry. This means that countries not only must ensure that the deficits and debts goes in the same direction, but also that the interest rates that they are paying in their debt goes in the same line. They have exactly the same rates. Right now, it has been commented, for example, when the governor of the European Central Bank said that we are not here to close the spreads. She was meaning that. She was meaning that the countries should do the effort to ensure that they don't deviate from the long-term interest rates in their public debts. Why? Because this would create some imbalances. For example, we have that right now Germany has a negative long-term interest rate, while Spain has a positive one. That means that if you want to lend money to Germany, you're going to receive less than what you lend. While if you do it with Spain, you're going to get a return. This creates some kind of frictions and is putting Germany in a much better position to get money from the private market. So, for example, here we have the results of these criteria. We can see, first of all, in terms of the Euro area consumer price index, the CPI or the inflation, how always the countries are moving pretty close in the same direction. We are comparing here Germany, Spain, and France, and you can see that there are minimum deviations. However, when we look at the famous long-term interest rates, in particular the 10-year government bond interest rates, we observed that obviously before 1999, the effort to converge induced values was very, very good. And we result in a period of very close, we closed a lot the spreads. However, for almost 10 years, we were in that very comfortable scenario, but after the financial crisis in 2007, those spreads started to increase again, losing these convergence criteria. This implies that countries should try to do an effort to recover these values, but we can see how this has had positive effects in the past. Now, going a bit further in terms of the macroeconomic policies in the Eurozone, we have that the Eurozone has actually just one proper macroeconomic policy, which is what? The famous monetary policy, because we are giving up with our currencies. We accept a unique monetary authority in the Eurozone. In this case, is what we call the European Central Bank plus the Euro system. So it includes all the national central banks, okay? And as usual, they have the traditional monetary tools, which are controlling interest rates, and after the 2007 financial crisis, the quantitative easing, okay, which means printing money. However, they have also created a new institution, which is part of the ECB. It's an umbrella of the ECB, but with a different, totally separated internally, is the famous SSM, which is taking the authority for prudential supervision of the banking system. Now, what about the fiscal policy? Well, actually, there is no proper fiscal policy in the Eurozone. This is a national tool, something that countries should apply in their freedom. However, we have to emphasize that they must still continue following the Maastricht criteria convergence criteria, sorry. On the top of that, we have that the European Union also set something that is called the famous fiscal rules, which implies that countries should always have some kind of adjustments to ensure that they achieve the targets set in the Maastricht criteria. How they set this rule? With the famous automatic correction mechanisms, which states how you should move from a high deficit to a low deficit, what kind of policies you can implement, and so on. Now, from a supply side, again, we don't have that the Eurozone has a proper tool. However, those tools are into the famous European Union framework, such as competition and so on. Here we have an example of how do countries, why is important macroeconomic, the monetary policy. Here we have how do countries react when the ECB increases the interest rates. So in economics, we don't only care about, okay, there is going to be a negative reaction, we increase interest rates, now investments becomes more expensive, companies doesn't want to invest, this is gonna reduce the demand, and therefore we would expect a reduction in the GDP. Also, we want to say, okay, in this scenario, how much or how many percentage points should the central bank reduce or increase in order to mitigate the effects of a crisis? So here, for example, we have what are the different reactions in the different national countries as a consequence of an increment of 1% in the ECB intervention interest rate. You can see that for the case of Germany, we find that the most probability is going to reduce 0.4% the industrial activity. So we can measure, in economics, we take care of this when we want to give policy recommendations, what are the effects of not only increasing, but also by increasing, exactly 1% or 0.25%. And let's finish with the last responses that we have from the COVID-19 in the European Union and the Eurozone. We have that the Eurozone responses has been via monetary policy, again, quantitative easing, and by purchasing public bonds to ensure the liquidity of the different governments in the Eurozone. But also, keep in mind that we don't have a proper fiscal policy. It has been proposed a common fiscal instrument, meaning let's try to create, in the same way that we have a common currency, a common bond. Some people was talking about the Corona bonds, some other was talking about the Euro bonds. However, this is a proposal and doesn't seem right now to be something that is going to be implemented in the short run. However, we have something in the Eurozone that is called the famous European Stability Mechanism. It works like the International Monetary Fund, but for the Eurozone. And it has implemented some unconditional credit lines for national, to cover the extra expenses of national health systems. However, we have the door open also to provide conditional credit lines for other purposes. So if a country for the negative effects of the COVID needs more money, they can ask for a credit line, but this is going to be a conditional credit line, meaning it's going to imply that we're going to have to do some adjustments by cutting expenses here or there. However, in a much more broader framework, we have that also the Eurozone is going to be benefited by the European Union responses. From the demand side, we have that the European Union has flexibilized the EU's fiscal rules, somehow spend as you wish, obviously with control. From the supply side, we have that the European Union has created the famous SURE, which is SURE, the Support Mitigating Unemployment Risk Mechanism, which is going to fund the furloughs. So we have that right now, most of the countries have been controlling the unemployment by, okay, don't fire people, we are going to be paying for those salaries. Where this money is going to come from? From the SURE. And what right now the European Union is negotiating is the famous EU Reconstruction Fund, which is going to be like a kind of a new Marshall Plan, which is going to be funded with, seems that it's going to be funded with a 50% of transfers, which implies that there is not going to be repayment of these transfers. Somehow we have that rich countries in the north are going to be sending resources in terms of money to the southern countries, but the other 50% is going to be normal funding, which implies that the countries are going to have to repay, but probably with very mild conditions. Takeaways. We have that the macroeconomic policies are always, it's an applied analysis of macroeconomic theory. Okay, so the macroeconomic theory says something, set or predicts some kind of relationships, while the applied analysis is going to say you have to increase at 0.25% and so on. And also, from a perspective of the Eurozone, we have that there are some advantages of being part of the Union. For example, accessing to the EU or Eurozone funding via the ESM or the SURE. However, it has some kind of disadvantages. For example, this help can be conditional, and also where the money comes from, who is paying for that. These are the kind of questions that we like to answer from the perspective of the macroeconomic policies. So thank you very much. And if you have not applied to study with us at Essex, you can follow the links and ask me any question if you have any.